Hello everyone, welcome to this video on IAS 32 Financial Instruments presentation. In this session, we will understand what IAS 32 is all about, why it is important, and how it helps us classify financial instruments correctly. IAS 32 is one of those standards that students often find confusing, especially when it comes to equity versus liability classification. So in this video, I will break it down step by step using simple language and practical examples so it becomes much easier to understand. Let's first understand what IAS 32 actually deals with. IAS 32 focuses on the presentation of financial instruments in the financial statements. It tells us how a financial instrument should be shown, whether it should be treated as a financial liability or as equity. The main issue IAS 32 addresses is classification. For example, should a particular share or debenture should be shown as debt or equity? That decision matters a lot because it affects profit, ratios, and the balance sheet structure. IAS 32 works closely with two other standards, IFRS 9, which deals with measurement, and IFRS 7, which deals with disclosures. So think of IAS 32 as a classification and presentation rulebook. Now let's look at the scope, meaning what IAS 32 applies to. IAS 32 applies to almost all financial instruments. This includes things like shares and preference shares, bonds and debentures, loans taken or given, trade receivables and payables, even derivatives in terms of presentation. It applies both to the issuer of the instrument and the holder. So whether a company issues a bond or invests in one, IAS 32 is relevant for both. Although IAS 32 has a wide scope, not everything is covered. Some items are excluded because other IFRS standards already deal with them. For example, investments in subsidiaries or associates are covered by IFRS 10 or IAS 28. Employee benefit obligations are covered under IAS 19. Insurance contracts fall under IFRS 17, so IAS 32 does not replace other standards. It only applies where financial instruments are involved and where no other standard specifically applies. Before going further, we must clearly understand the three key terms. First, a financial asset. This includes cash, a right to receive cash, or a right to receive another financial asset. Secondly, a financial liability. This means a contractual obligation to pay cash or transfer another financial asset to someone else. Third, an equity instrument. This represents the residual interest in the company's asset after deducting liabilities. In simple words, equity holders get what is left after all liabilities are paid. Understanding these three key definitions is very important for exams and real-life accounting. This slide is the heart of IAS 32. The most important rule is classification depends on the substance of the contract, not its legal name. So even if something is called a share, it may still be a liability. Ask this simple question: is the company obligated to pay cash or not? If the company must pay cash, it is a financial liability. If the company has discretion, meaning payment is optional, it can be equity. This distinction is crucial because liabilities affect profit or loss through interest expense. Equity distributions do not affect profit or loss. Now let's talk about recognition. A financial instrument is recognized when the company becomes a party to the contract. This usually happens to the trade date when the agreement is entered into. At this stage, the company must decide, is this a financial asset, or is it a financial liability, or is it equity? This classification is done at initial recognition and normally does not change later, unless the terms of the instrument change. So getting it right at the start is very important. Some instruments are not purely liability or purely equity. These are called compound financial instruments. A common example is a convertible debenture. Such instruments have a liability part like interest or repayment obligation, an equity part like an option to convert into shares. IAS 32 requires these instruments to be split into two components at initial recognition, one part shown as liability and the other part shown as equity. This ensures proper presentation and avoids misleading financial statements. IAS 32 itself does not focus heavily on measurement, but it gives the basic idea. For compound instruments, the liability component is measured first. The equity component is calculated as the balancing figure. After initial recognition, measurement is mainly governed by IFRS 9. So remember, IAS 32 is equals to presentation and classification, and IFRS 9 is equals to measurement. This separation helps avoid confusion in exams. Presentation is another major part of IAS 32. Financial liabilities and equity must be shown separately in the balance sheet. They should never be mixed. Income and expenses are also treated differently. Interest on liabilities goes to profit or loss. Dividends on equity go directly to equity. Offsetting, meaning netting assets and liabilities, is allowed only in rare cases where a legal right exists and not settlement is attended. Otherwise, gross representation is required. IAS 32 also focuses on clear disclosures. Companies must disclose enough information so users can understand the nature of financial instrument, how they are classified, and how the important terms affect future cash flows. Most detailed disclosures are provided under IFRS 7, but IAS 32 sets the foundation. Good disclosure improves transparency and decision making for users. Let's understand this with a simple example. Suppose a company issues convertible debentures. The interest payment creates a financial liability, and the option to convert into share creates equity. Under IAS 32, the liability part is measured first. The remaining amount is treated as equity. This split ensures that the balance sheet shows the true nature of the instrument. Now let's look at an exam style question. If a company issues redeemable preference shares with mandatory dividends, how should they be classified? Even though they are called shares, the company is forced to pay dividends and redeem them. So there is a contractual obligation to pay cash. Hence, under IAS 32, these are treated as a financial liability, not equity. This is a very common exam trick, so always focus on obligation, not the name. To wrap up, let's quickly recap. IAS 32 deals with presentation and classification. The key challenge is distinguishing liability versus equity. Substance over legal form is the golden rule. Compound instrument must be split. Correct classification improves clarity and reliability of financial statements. If you understand these core ideas, IAS 32 becomes much easier. Thank you for your time and attention. If you found this session helpful, feel free to like, share, or subscribe for more lectures on auditing and accounting topics. Thank you.